Hey, what's going on, guys? I'm Steve. Welcome back to the channel. Welcome back to another video. If it's the first time stopping by the channel, hit that subscribe button. Trust me, you won't regret it. If you're a returning subscriber, as always, welcome back. Guys, I'm going to talk a little bit today about a phrase I say a lot. You know, I might say, when I'm talking about my investment videos, I'll say, well, this is how I can sleep good at night, or this is why I don't worry about the market. And, you know, a lot of people, especially people that want to get into the market, a lot of people, they, how can I say this? They want to make the step, you know, they sign up and get a investment account set up. They put money in there. And one of the hardest things is to start, you know, picking your first stock. You know, it sounds easier said than done, but with tens of thousands of different companies out here to choose from to help you on your road to financial freedom, it's a very hard decision to make your first purchase. But I want to talk a little bit today about something that's very easy and something every beginner should do. Like right now, the market is in turmoil. You hear the word turmoil? Like this morning, the market ran green, and all of a sudden I looked, and it then fell apart. Like it then fell off a cliff or something like that. You know, and then we're sitting up here. All three major indexes are well into the 1% range in the red. I'm going to talk a little bit about ETFs today and why I say I sleep good at night. And ETFs are awesome. How can I say this? An awesome investment for new beginners or people, you know, that have that are going through, you know, the turmoil right now. A lot of having ETFs eliminates that. Perfect example. One of the benefits of having ETFs or exchange traded funds, which is basically an index fund where you don't have to put the high amount of money in to get started being in the fund and then trickle money into it. ETFs, you know, they all have different ranges of money, and it, like, you know, it's an exchange traded fund. So it's almost like buying a stock, but you're buying an index fund. And that's one of the great things about it. And I've been dealing with these for about, I'm going to say, the past 6 years. And I've been dollar cost averaging into them. So my cushion and my bearing on what the market is doing right now, honestly, I could care less. Because when you deal with an ETF, you're dealing not with just one singular stock. You're dealing with a bunch of stocks, different sectors, different styles of businesses, all put together in one basket, per se, in this fund, to where you get a broad exposure and you mitigate a lot of the risk because it's spread out amongst a bunch of companies, you know. And I'm going to talk a little bit about today about my portfolio. Like I have 5 ETFs in my portfolio, and I never did a video on this. And I want to talk about a little bit about the stocks I have and what percentage of my portfolio they are. Now, this is just one of my 3 portfolios, but I do have all my ETFs in one portfolio. I'm going to talk a little bit about it. As far as ETFs, like I said, you know, you get a broader exposure. A lot of people get indecisive sometimes. Like when I first started, I was like, I want to get Apple. And then, you know, you start learning about Microsoft. Microsoft starts to come on. And then Intel was kind of up there a little bit too. And I'm like, man, I want all 3 of them. But you don't want to have your portfolio where all the tech stocks, you know, tech stocks lined up like that. Because if tech takes a hit and they're individualized like that, a lot of times it can play a major role on pulling your portfolio down, especially when you allocated a lot of money in these stocks, you know. But as far as it, like I said, to give you a broader exposure. That's the first thing, is your broad exposure. You don't have to worry about picking a winner and all this other stuff and making sure that you got the best tech company out. Because you got to remember, technology changes every 5 years. It rotates. Whoever's down right now might not be down. You know, they might be up. And vice versa. It all comes down. You know, each company got their own different teams and their own ideals of where they want to go and directions they want to go. Second thing is, like I said, it cushions your losses. You know, if I have Apple, we'll go with Apple again. If I have Apple and Apple drops in price, say they have a scandal and the stock just temporarily or just starts to have a rapid decline. If I have 30% of my money in Apple, you know, just a singular stock Apple, instead of having it in the ETF, an exchange traded fund, where Apple was a part of it, but it's a part of multiple businesses, that 30% is not going to drop in the ETF at all. So, I mean, at all, like, you know, we would drop it as a singular stock. So you save money and you save the headache and you can sleep well at night. It's a security measure. You know, ETFs are comprised of many businesses in the one fund. So as one is going down, a lot of times other ones in other sectors are going up. You know, like I said, it all comes back to investment ease. You know, you put your money into a fund, it's spread out amongst a lot of companies. Some do good, some might not be doing well at the time. A lot of times, the whole thing as a whole goes, if we have a bull market, the whole thing takes off. And, you know, you have a pretty nice gain. But let me talk about my holdings. 51% of my ETF portfolio is VOO, ticker symbol. And that's Vanguard S&P 500 ETF. So basically what it is, and you know, you'll hear a lot of people, a lot of YouTubers talk about Vanguard, VOO, and they'll say, oh, well, it's the S&P 500. The S&P 500, you know, with it being its own index, is the top 500 businesses in America. If you invest in the S&P 500, like this is what got me interested in it, you know, investing in the S&P 500 ETF is actually like owning 80% of American industry companies. You know, and that's a big thing. 51% of my portfolio is the S&P 500. So basically, it's tracking the S&P 500. These are the businesses in it. They're broken down 500 companies. My money spread across 500 companies. I don't have to worry about it. All the major companies you see the talking heads talk about on TV are in this fund. So ETFs are an awesome way to where you don't want to pick your own stock, or you don't want to have you think you got to have a financial manager and all that stuff. A lot of times, depending on your age, the higher you get up, a lot of times they put your money in the S&P 500 to mitigate your losses. That's why 51% of this portfolio is S&P, is VOO. Second stock I got is 17%, and that is VTI. That is the total stock market index, meaning all of the stocks, right? 17% of my money is in that, right, of the portfolio. Now, my thing with that is it takes a broader array of other stocks, right? Not just do I have the S&P 500, you know, top 500 businesses in America. This ETF tracks all of the total stock market as a whole. So my money's in other companies as well. Now, a lot of people, sometimes they'll pick VTI over VOO, right? And it all comes down to what you want to do, guys. Me, I added both of them, and I made VTI a smaller, you know, section of my portfolio at 17%, because my portfolio mainly runs off of American businesses. Thus, the 51% goes to S&P 500, which is VOO. BTG is my third position, and I'll do VTG and I'll do VHT at the same time. Now, you'll notice, besides one of my profiles, one of my stocks or ETFs, I deal specifically with Vanguard. I'm a fan of Henry Bogle. You know, Jack Bogle. I'm a fan of his, and I really enjoy, you know, the low expense ratio and everything that Vanguard offers. Plus, I was introduced to it, you know, through somebody else, and the more I learned about Jack Bogle, I liked it. But 10% is VGT, which is Vanguard Information Technology. So it's just tech, you know, all the tech companies. You got Apple, Microsoft, Intel, the like. 10% of my portfolio was in that. The reason why only 10% is in that is because right now, you know, technology is the future. And when technology is running high, so does the market. A lot of the reason why we're not in the, you know, the market is taking a hit, because a lot of people are trading out of these tech companies. They're like growth companies. Anytime we have any type of recession or anything like that, these tech companies, a lot of times they take massive hits. Like right now, this is down 29% year to date, you know, as is the market. But once this thing turns green, these tech companies take off, you know. So information technology is my 10%. I have another one that's 10%, and that's VHT. VHT is the Vanguard Healthcare ETF. Basically, you know, everybody says health is wealth, and I agree with that. You know, in here, in this, in the VHT Healthcare ETF, you got hospitals, medical devices, drug companies, anything dealing with health or health services is in that stock. People are always going to be sick, people. You're always going to have people that's sick. So, I mean, me, that was a no-brainer. Now, I have it at 10% because, you know, VOO takes a massive amount of the shares of this portfolio. So I allocated the money where, you know, I ran tech and I ran healthcare at the same time, you know, neck and neck a little bit. This stock portfolio that I have with these shares, I'll never sell them. You know, this is one of them set it and forget it. Technology will always be around. That's propelling us to the future. Healthcare, people are always going to be sick. Death is a natural, it's just as natural as life is. I'll always keep them. Will I increase, you know, where they are, you know, the amount, percentage? Yeah, over time, you know, with the times, I'll adjust. But I mean, for now, it's good for me. One of my favorite stocks, I mean, ETFs, comes in, it's it's at 8%. Now, 8% of my portfolio is the Schwab USD dividend equity ETF. I cannot talk today. And the reason why I like that is it's all the businesses with high dividends. You know, companies that pay you your percentage of owning the companies. I'm big on dividend stocks. Thus, you have, you know, the US dividend equity ETF, and that sits at 8%. My last one is real estate, which is Vanguard VNQ, right? And that's the Vanguard Real Estate Index ETF. Commercial and residential housing companies, they're all in this. Housing has been taking a hit. That's why my VNQ, you know, a lot of people are big into real estate. You know, I understand real estate is going to always, you know, be here. People are always going to have a demand. Human beings are populating the planet. We're going to expand and all of that. I put VNQ at 5% of my portfolio. You know, just the real estate part, just to get some exposure to it. But I mean, guys, man, I've been dealing with ETFs for a long time. And I like them because you don't have to worry about them. You don't have to be an expert. You don't have to go get an expert. A lot of people take, you know, you'll hear people say, oh, you need a financial advisor. No, you don't. You just need proper planning. I mean, everything's lined up for you. If you, it's like seeking, you shall find. These are my portfolio. These are my 6, ETFs in my portfolio. I feel good about them. I feel good about the percentage and the amount that I've invested in them. I still dollar cost average in these things, you know. But I mean, as far as right now, picking regular stocks, you know, I haven't made any videos lately of me picking stocks because we just fell off the cliff today, you know. And I mean, we've been sliding, but I think we fell off the cliff today. And honestly, these ETFs will save you a lot of headache, especially if you were a beginner. Man, I suggest everybody get ETFs. And the reason why is it's a lot of uncertainty in the market. You don't want to be messing around and getting caught up right now, especially if you're still learning the jargon and definitions of what things mean. Because, I mean, this is a slow process, guys. But, I mean, this right here, it's a no-brainer. Just having VOO and investing in that by itself, you can retire rich. A lot of people say, oh, being rich is easy because it takes discipline. That's a perfect example of it. You can just have VOO. That's like 500 businesses right there. You know, a lot of people say, hey, I got rich with index funds. All of these are index funds. And the thing that's good about it right now, and that's cool, is this. Look at the way the market has fell. This is why I say you don't want to be messing with stocks right now. If you're not really a seasoned type investor, and you're not really into looking at 10Ks and reports and all of that. Right now, S&P 500 VOO is down 17%. DTI is down 19%. Year to date, this is year to date right now. So these are 20% off. This is 19% off. It's normal. So DGT, information technology, guys, is 29% down. It's down year to date, 29%. Healthcare. Now healthcare is down 5%. You know, healthcare ain't gonna slip like that, because people ain't gonna all of a sudden en masse just get healthy and then these companies start closing down. Even in the recession, healthcare holds firm with its value. So it only dropped 5%. Now, I think the 5% come from a lot of drug makers and all that. You know, pharmaceutical companies. I think that 5% drop is mainly from that. You know, it's hard to dictate when, you know, certain drugs are going to be taken off and certain drugs are not. So, but SCHD, another one, high dividend. People put their money in high dividend companies. You know, stalwart companies, blue chips. SCHD, all blue chip stocks. People don't sell them when times get bad. You know, they perform. That's only down 2.9%. So it's a pattern. See the pattern? Things that are of necessity and things that are proven, you know, they don't drop that much. Now, I'm not saying BTI and VOO is slouches. They're not. But, you know, they're comprised of a whole bunch of companies. And a lot of the companies that they have in them, they have a small, minute share. And thus they bring down the index. But in VNQ, you know, housing is getting smoked this year. You know, they're predicting that a lot of houses ain't going to be sold. Some builders supposedly got houses they can't sell right now because of the rise in interest rates. We don't know what the Fed's going to do. It is what it is. VNQ, Real Estate Index, Vanguard, ETF, 25.6% down. And the reason why I bring this up, guys, is this. These numbers are not to scare you, to show you the opportunity that's presented to you. You know, if you can buy into these right now, a lot of people have just, you know, a lot of people are new investors and they might have been investing for a couple of years and not even been introduced to these type of funds, these ETFs. And for me, VOO, I'm going to just talk a little bit about VOO. VOO is one of those stocks where 50% of your portfolio or any portfolio, a lot of people suggest you put that in VOO because your individual stocks start taking a hit. 50% of your portfolio is protected and it'll be growing slow. Imagine, you know, a lot of people, if you add up all the paper assets that you have, you know, like your individual stocks, and calculate how much year to date you're down off of your money, VOO was only down 17%. I guarantee you a lot of people are down way past that. Some of these stocks are 40, 50, 60, 70% down off of their normal highs. VOO only down 17%. So imagine, you know, how comfortable you'd be at night, especially when you're near retirement, knowing that you're only down 17%. But anyway, guys, I just want to talk a little bit about that. You know, as far as making these type of videos, these stock market videos, somebody left a comment and was like, hey, you know, you seem like you're making more other type of videos other than financial videos and stock market videos. The reason why is this. Let me explain this to you. Number one is I don't want to talk about the same things over and over again. Like you'll see a million people make videos about the Fed, sometimes 2-3 times a day for one YouTuber. Nothing is changing with the Fed. Unless we come out with another Fed meeting where they say they're going to drop or raise the rates, then I'll report about it. But anything else is hearsay. I'm not going to get on here and I'm just not going to just say, hey, just make something up just to buy some time, you know, and it's repetitive. I don't think that's fair to you guys at all. So, I mean, we are where we are. But as always, guys, like, comment, share, and subscribe. I'll see you guys in the next video. Hopefully, some of this stuff, you know, get you to think and go do some research. You know, I'm not giving you no advice or anything. I'm just telling you how my portfolio looks and, you know, what works for me on my journey. But guys, I appreciate you listening to me ramble as always. I'm up here burping and stuff I just ate before I get on the camera. I don't know why I keep doing it. But anyway, I'll see you guys in the next video. Take care.